What is up, everybody on YouTube and Telegram, where I'm going out with this live stream? I wanted to jump on here on a Monday at the end of the year. News cycle is a little bit slow. Markets are a little bit slow. People are on, holiday break, Christmas break into New Year's, but we are still watching the markets. A lot of things happening in the sound money space, Bitcoin, gold, silver. So I wanted to jump on here and talk about this. If you guys are watching this on YouTube or you catch this later on YouTube, make sure you join the Telegram, t.me/Bitcoin and markets. Pretty sure it's linked in the information section down below for this video. So jump on there. It's a smaller community, tight, close knit, but we go back and forth about everything Bitcoin and macro. So make sure you check that out. Here is a chart of, let me share the screen with Telegram. Sorry, guys. Share screen. Let me get to it. There we go. So here is silver, and you can see big blow off top on Friday. We were talking about that, of course, in our community, tweeting about that a lot, talking about, hey, silver, it could go higher, but it's very close in time to the top. Um, we listened to another podcast. It's called Gold Fix, and commented on some of these things in the silver market and stuff. But my overall position was that this was a financial driven process. It was being pumped up because of natural squeezes. They're squeezing all the shorts, squeezing all the options, and end of the year really just exploded that squeeze to the top side. And today we have almost a completely bearish engulfing candle at a top with massive overbought conditions. If you go on the monthly, I mean, it's the most overbought on the monthly. Same with gold since early 1970s. Well, for silver, it's ever looks like. It's even bigger than, well. This data is not going back to that 1980, the Hunt brothers back in the 80s silver squeeze, but it's the largest this century for oversold conditions. And if we go to gold, it's going to be very similar, going back to 1973. So very overbought conditions, very overheated. And I was saying, it's I can't call a top, but I can say we're getting close to a top. And you can see on gold all the way down to the 20-day moving average, all the way down to 4,300. So this is a 4% drop for gold today. And let's take a look at silver. Silver's 8%. At one point, I think it was over 10%. I mean, if we just go from the top though, not the open to the bottom, it was 15%. I mean, that is a massive, massive move. And silver likes to do this. It likes to rally, spike really hard. It's spiked a little bit later than gold, but caught up very quickly. And now I think it's just set for a generational. This is a generational top. So in my investing career, let's say I continue to pay attention to markets and stuff for another 20 or 30 years, I think it might be the top for silver. I really do. A lot of people are talking about, I saw Luke Groman out there tweeting that, hey, there's 500 pounds of silver in each Tomahawk missile and blah, 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 blah. I mean, those type of arguments, they don't consider a balancing effect. Okay. In economics, you can't just extrapolate from one piece of data. Say, okay, well, there's 500 pounds of silver in a Tomahawk missile. Let's say we're going to be expending a lot of Tomahawk missiles over the next 10 years. That means we need X amount of silver. There's only this much silver, blah, blah, blah. No, because there's a give and take. There's a balance. There's substitutes. There's different things you can use. Start pumping out some drones, switching over to drone warfare. And, there's give and takes in economics. It's not a straight linear thing. And there's actually disincentives for it to be a linear thing like that. So I think personally, I think this the demand for commodities is going to go down over the next 20 years. Now, that's not a popular opinion out there. A lot of people really disagree with that opinion, but I believe because of demographics, shrinking populations, deglobalization, we are going to see a slowdown in the global economy and a pullback in the demand, the absolute demand for commodities. Of course, I've been saying this about oil, but I'll say it about silver as well because it is more of an industrial metal. I mean, Luke Groman was even saying stuff like they're going to settle, use silver in place of U.S. treasuries. I mean, that's possible, but it's very, very unlikely. If anything, they would go to gold. And before they would go to silver, I think they would go to Bitcoin. But yeah, this is what we're looking at for the silver market. I did end up selling a little bit today. So I was a gold and silver bug before finding Bitcoin. Um, let's see, about however many years ago, a dozen years ago. And I still held on. And this year, this generational bull market, I have been selling as we go up. I'm actually pretty excited to be getting over $50 for silver. Um, but yeah, I think this is a generational top for silver specifically, but gold as well. Gold, I think we could be putting in a multi-year high here on gold. And what does that mean for Bitcoin? Well, usually, like I've said many times, um, Bitcoin is takes off after gold. So over the last couple years, when gold would have a move up, Bitcoin would follow. And it's not like a lot of people say that Bitcoin sniffs out liquidity. Bitcoin is a leading indicator for global liquidity, but it's showing here its relationship to gold is not that. Okay, so gold moves up, Bitcoin moves up after gold is done with its move. So that's what we're seeing. Let's take a look at the Bitcoin price. Very disappointing. You can see the 20-day, 50-day spiked up to the 50-day. It was the closest we got to the 50-day since back here in October. So this is getting to be a good level with seemingly strong support. It has broken through this trend line, this red trend line coming down. If I remove the moving averages, you can see this trend line has multiple points of contact. It was a real thing, and we broke above it just because we went sideways out of it. So that's what we're looking at for Bitcoin. I do think that we can see some rapid price movements in the new year. Uh, we had all the expirations of all the options last Friday, so there's less pinning effect that is on Bitcoin right now. Of course, that can return relatively quickly, but we have a couple weeks here where there's going to be less resistance to the upside. And if we see some big buys, some reallocations into Bitcoin over the new year, in a less pinned environment, then I think we could see some fast upside move. And what do I mean by reallocation? So if we're down on the year, right? Bitcoin is down on the year. If we go year to date and do percentage, -5%. So let's say you have a 2% allocation in your portfolio, or some large institutional investors have a 2% or 1% allocation to Bitcoin. Well, that is now down a little bit lower relative to the rest of your portfolio. If we put it into, if we take a look at the S&P 500 year to date, plus 16%. So that has grown. If we do a TLT to simulate the bonds in your portfolio and we do year to date, that's roughly even. So Bitcoin is as a allocation, it has gone down. It's maybe at 0.8%. Let's say you had a 1% allocation, it's now 0.8%. That means you have to buy Bitcoin to get it back up to 1%. Same with MSTR. So let's say you're Norway's sovereign wealth fund and they own a bunch of MSTR, and they have this that they want to keep it at a certain percent of their sovereign wealth fund, and MSTR has gone down. Well, at the end of the year, they have to reallocate. They have to buy more in order to keep that allocation the same. So I think we're going to see some of that in the new year. And what does that mean? It means we could see a price movement pretty quickly up to back up to at 100 very, very quickly. I don't know how fast we get to a new all-time high, but it could be within 2 weeks we're back up to a new all-time high and off to the races. So that is that. Let me check the chat and see if there's anything going on for viewers on YouTube. Guys, like and comment down below. I'll answer any questions that you have. Let's see if there's any questions on Telegram or comments. All right, not seeing any. Then let's roll into a few more things. Make sure I share this with everybody. Okay, so we are here on Twitter. Just wanted to go through a few tweets here. James Van Straten, he is senior analyst at CoinDesk. You can see there. And he says top is in for metals. The question is how long until they make new highs. Totally agree with this. Like we were saying, I think this is a generational top for silver. I mean, you're talking another 20 years maybe before. I mean, we could bounce and go higher still right now immediately. But absent that, the time frame, like this period of time right now, is going to be a generational top for silver. Gold, maybe we could be looking at 3 to 5 years, might go a little bit higher, but it also has had a pretty massive run. We do need some consolidation in both precious metals there. Okay. Now I saw this. A couple people were showing around or retweeting using this video here, and I think that this is there's so many things that you can do for this. Particularly, they said members of Congress pretending to do something. And you can see, obviously, this kid is pretending to slow down the subway, then pretending to open the door, then pretending to shove it off. I mean, this is the same exact thing with what? You dropped it? Okay. I would say that this is what the Federal Reserve is doing. This is monetary policy. This is what they do for monetary policy. They pretend to do it. They're building the narrative, and then turn around and be like, okay, I expect this to happen and this to happen. I mean, this little video could be used for so many things. Okay, it looks like the U.S. has conducted a land strike against Venezuela. It sounds like a port facility, the drug port where they were loading up all the drug boats, and that facility has been struck. It's the first thing on land to be struck. So we'll see if this snowballs anymore in the next 24 hours. All right. Oh, this is funny. This play on this meme, Mom, how did we get so rich? Your dad owned a daycare in Minnesota. 100 million views for Nick's video about this, going absolutely viral. It's going to make a big difference. Now they're finding different fraud from similar groups all across the country, from Washington to Ohio. And I think there's going to be a lot of this fraud, and not just Somali. I think they're going to find NGO fraud of all sorts, all sorts. So hopefully that can get cleaned up. Okay, here's one about Bitcoin. Long-term holders have stopped selling, and it's go time. Let's see what this is. Bring this up. I shared this with Telegram earlier. One of the stories recently has been a lot of OG selling. These would be long-term holders. Technically, long-term holders, I think, are 155 days. I don't know about check on chain exactly what metric that they use, but some of the other sites for long-term versus short-term holders use a day like 155. I don't know why they picked 155. If there's some change in behavior that we typically see around that, but why not 180 or 120? They picked 155, and so it's kind of arbitrary. But we have heard that OGs have been selling a lot of coins, and now it looks like these long-term holders are starting to increase their holdings now instead of selling. So that is huge for price. We will see how that works into the new year and all of the things I mentioned before that are kind of coming together fruition at the same time. Make sure that we got my levels all correct. You guys, if you're watching on YouTube, comment down below. Let me know what you guys are thinking out there. Haven't been streaming much on this channel. I do have another channel, Rogue Macro. You can find that. I've been streaming more on Rogue Macro. And the reason that I started that second channel and second handle on Twitter is because the Bitcoin market, the addressable market for Bitcoin is stagnant or shrinking. And so, branching out into a larger market with a new brand is my goal here. So anyway, make sure you guys subscribe over there, Rogue Macro, both on YouTube and Twitter. Okay. Yeah, let's talk about this one. This is a Rogue Macro type of um, topic, demographics. So I say the amount of social programs. Oh man, I this is a typo. In the most important word in the whole thing. Oh wait, no, I didn't. Sorry. No amount. Okay, no amount of social programs can avoid disaster. They waited too long. There's simply not enough fertile people to bring fertility rates up by that much. Come here. Sorry, my son is interrupting. Let me see. Okay. Um, yeah, so fertility rates changes. You can look at these average ages. I just put these arrows on this chart. So this is obviously fertility, like actual biological fertility, not fertility rate by how many kids you have, but like a biological fertility. Um, monthly probability of a pregnancy ending in birth. Okay. And age down here. So it really drops in the 20s. And then in the 30s, it continues to drop. At 40s, it peters out, but it's so low already. Now, Japan's average age is 49, Italy, 48, South Korea, 46, Germany, 45, Poland, 42. China is 40, and they're getting older faster than any of these countries. The US is at 39, but it's getting to the point where, you know, there's just not enough people to turn it around. And you're going to have a lost period. Okay. I'm not saying this is the end of civilization. It could be, but um, there's going to be a 40, 50-year gap in growth and all of that stuff because demographics are so bad. And Bitcoin can't save us from this. It won't necessarily collapse, but it will, just like it has been since 2008. Low growth, low inflation, the silent depression. Just think, going back to the Middle Ages, and they had obviously the plague years, but they also had the late medieval depression, right? Let me Google that real fast. Yeah. Is this what I'm looking for? Yeah. Okay. During the late 16th and early 17th centuries, A cultural and literary cult of melancholia emerged in England. Okay, that's not what I wanted. I think there's an actual page for this. Let's just read what this says here. So, the late medieval depression refers to a period of roughly 1300 to 1500 of widespread crisis in Europe, marked by immense hardship from the Black Death, famine, the Great Famine here, war, Hundred Years' War, and social disruption, leading to demographic collapse, economic downturns, and profound psychological impacts, often described uh, through concepts like melancholy. Okay, melancholia. This era saw a great depression in trade, production, and populations, with intense suffering fueling religious fervor, social unrest, and new understandings of mental distress beyond just sin. So, a lot of people have said that this coming demographic crisis, we haven't seen anything like the Black Death. And I would agree in a absolute figure, like absolute number figure. But the Black Death was it didn't discriminate against ages. And so you still had to have a lot of babies. There was just a much higher death rate. Okay. And now the demographic crisis is also older. Just like this image. Okay. The average age is this old. That's a crisis in and of itself. During the Black Death, the average age was right around this hump probably. The most fertile time was when that was the average age of the population. Now we have crashing demographics with the average age out here. So there's no way to replace people. Okay, so let me just keep reading. The Black Death and subsequent plagues drastically reduced Europe's population, causing massive labor shortages and societal upheaval. Yes, but everything went down in order, right? It's not like only um, certain professions died or a whole generation was killed off, right? You had this, it was proportional throughout the economy, maybe not proportional country to country, but what I'm trying to say is there's going to be a shift in the quality of economic activity today. So if you think about, we've talked about production, and usually production is a young man's game, right? In your 20s, 30s, 40s, you have high production and high consumption. And then when you get into your later years, you have lower production and lower consumption. And of course, in your very young years, you have no production and relatively low consumption. Okay. A 5-year-old is going to consume less than a 25-year-old. And so, but we have a qualitative shift along that continuum. The Black Death did not have that. The Black Death did not have a qualitative shift to an older population. It probably actually caused a slight downward shift in the average age. Because, the 1-year-olds can be replaced within a year or 2 years, whatever. But 50-year-olds can't be replaced. And so as the death happens in the Black Death, the average age is going to move lower. Today we have it where the average age is moving higher. Okay, I've beaten this dead horse, but economic shocks, bad harvests, famines, prolonged warfare, the Hundred Years' War, devastating agriculture, trade, and tax revenues, creating severe economic depression. Yep, and the main export of this time from Europe wasn't no longer textiles or wool or whatever. It became silver. And so you saw silver flooding out of Europe, mainly east to the Muslim world, and then further into, China along the trade routes and stuff. So you had a bunch of silver leaving. And so you had bad demographics, you had silver leaving, and the economies did not recover. The populations did not recover in the economies until they found silver again, by the way, in the German mountains. That was the big revival of European economy was when they could fix the money. So, social and political instability, yeah. So the same sort of things, and we've seen a revival in religion, especially United States. It's gone up drastically. It's probably not doubled, but it's probably risen 50% just in the last couple years since COVID, and I think that will continue. Okay, there's going to be a revival of religion in these places. Yeah, and revolution. We're seeing that with going back to conservatism and all that stuff. So there's some very big parallels here between the late medieval depression and now. So what am I trying to say that? So I'm not saying we're going to crash, but I'm saying that we're going to be in a prolonged period of this type of depression, low growth, low inflation. And with that, you will see famines. I mean, just think if this global supply chains broke down for fertilizer, half of Africa would starve. There's going to be massive problems like this in the next 50 to 100 years. So this period could be known as the late modern depression or something like this. Okay, back enough of that. Let's go back. Let's see if you guys are talking about this at all. No. All right. Let's just do a few more posts and then we'll call it a day. What is it? 4:45. Okay, let's listen to this. So you guys know Raul. He's a bit of a scammer, and let's make sure this is coming through on Telegram. Yep. All right, he's a bit of a scammer. I don't think he's particularly insightful. He does run Real Vision, which is a fairly large and influential macro um, financial press type outfit. So he has far reach, and yeah. So let's see what he's talking about here. 8% is a hurdle rate, not in the United States. Come on now. Globally, maybe, but not in the United States. Okay, let's go back. They didn't even pause on that at all. Magic formula: GDP growth equals population growth plus productivity growth plus debt growth. Um, GDP growth. Well, I mean, why? Oh, man, GDP growth is kind of a misnomer. Okay, one. It's measured differently in Western countries versus China and also probably Africa and where because in Africa and other certain not all African nations, but a lot of African nations, there's a lot of black market stuff or gray market stuff that isn't necessarily counted in GDP. I mean, there's a lot of that in the United States too. Look at Minnesota. We're just talking about that. So there's a lot of growth and spending and all this stuff that happens that's not counted. And you get things like um, CapEx spending that doesn't actually have uh, current day productivity or current day impact, but it's counted with GDP. And China is different too because the way they count it is that they will spend as much as they are required to spend to get to the GDP number. So they have a goal, grow by 5%. And if they left things, alone, they wouldn't grow at all, or maybe 1%. So how do they get to 5%? The local governments simply spend more money on more infrastructure. Period. That's what they do. And that's not a way to get good growth. That's not sound, sustainable growth. What they're doing is they're actually taking away from people, from the consumers, from the people, and investing it in infrastructure that they won't even use. And they're impoverishing the people to build the infrastructure that's going to be subpar. You've seen the concrete falling apart. You've seen the bridges collapse. They didn't do the right seismic study on the mountains and stuff. Um, you see big sinkholes. You see all this stuff. So it's stealing from the people to construct it to meet the GDP targets. That's not going to last, and it's going to be wasted. And there's a cost to maintain those things. So, like, if you build a brand new mega airport, which we see pictures of these mega empty airports over there in China, and you have to spend money to maintain that, but it's not even really used. It's not paying itself off. It's not paying itself off of the initial investment, let alone the maintenance costs. So you have to further impoverish your people just to maintain it. So why don't you just let it go and let it fall apart in 20 years? Okay, that's what China's facing. But anyway, back to this GDP growth plus population growth plus productivity growth plus debt growth. Well, debt growth is dependent on population growth to a high degree, not 100%, but within debt, there is an implicit population number in there. Okay. If your population is growing, you can carry more debt. If your population is shrinking, you can carry less debt as a people, as an economy. So, implicit in debt growth is population growth. Okay. Productivity growth, this is a little bit of a wild card because, um, you know, we can have productivity growth, but that can go towards unproductive, unsustainable stuff. So, like, if you look at China, their productivity growth has really exploded, but it's they're productively building unproductive stuff, right? So productivity growth is kind of a misnomer as well. You'd have to dig into that, like, what is actually the productivity growth here? Is it just paper growth, or is it real growth? Is it wasteful growth, or is it sustainable growth? So productivity growth is really hard to measure. So really get down to the brass tacks of all of this stuff. It's population. That is the biggest single cause of GDP growth. And within that population, so that's quantity. Within that population, you also have quality. So you could have illiterate population or a literate population. You can have an advanced, educated, highly educated population, or a just a middle education population. You could have low specialization, so it's a primarily agrarian economy, or you can have high levels of specialization. It's a primarily urban society. So there's all sorts of qualitative things around population, but the main thing is population growth. That's the main thing you have to have. So anyway, long discussion. There will be a debt jubilee. They'll just wipe away that debt eventually, especially if we become isolationist and we have other countries becoming isolationist. It's different when you are trying to preserve a global order and everybody to trust everybody. But if you're isolated and your 95% of your economy is within your own borders, you care about your people and all this stuff, there will be a debt jubilee. That's how they will get rid of it. But before that, the natural process is to isolate. So we will be going into a period of isolation, less international trade as a share of global economy, supply chains shrinking dramatically. And once that happens, then they will take it and be able to do a debt jubilee, but not until then. So in other words, this chart right here is a consequence. It's not a cause. Okay, cause and effect. This is not a causation thing. It is a consequence thing. The end of this era, this is what's going to happen. Right? It's not that this is causing the end of the era. This is caused by the end of the era. Okay, they're saying they can't hear the video. Let me try to reshare. Damn. Sorry, guys. Reshare. Audio tab. It said it was sharing audio.
Force
How about now?
participation rate, and against it is government debt as a percentage of GDP, inverted. Basically, all debt has been accumulated to offset the working age population decline.
How are you guys now? Let me know if you can hear the video if you're still here. Pretty sure it was good now. Okay, sorry about that. It had selected. I don't know why.
So they're trying to bolster growth by adding debts. And right now, they kind of have broken from 2000.
Okay, I missed that last couple minutes.
Inverted. Basically, all debt has been accumulated to offset the working age population decline. So they're trying to bolster growth by adding debts. And right now, they kind of have broken from 2008 onwards. They've broken debt growth. Debt growth is now just servicing of old debts, and interest payments keep accumulating. And government debt to GDP keeps going up. When you look at it in a log channel like this, you can kind of project where we're going to go, which is what Japan did. If we continue as we go now, we will end up by the, let's say, 2030 at 160% of GDP in debt. So it just keeps going. And you can't really stop it because we've got this aging population. And that is the cycle of using liquidity to offset debt. So basically what they're doing is printing money to pay the debt. That's like using a credit card to pay a credit card. That's the whole game we're in. This is the debasement of currency. This is the game.
It's not technically debasement of currency. You guys know that debasement is only possible if it's got a backing. Okay, so 1 unit of debt is still payable by one unit of currency. In the past, it would be, this is 20 grains of gold. Now it's 19 grains of gold. Now it's 18 grains of gold. That's debasement. This is not debasement. And it's not actually, if you're printing money to pay off debt, that is not technically inflationary either. Okay, let's go.
Why the rich get richer because they own assets, the poor don't. Because
it's kind of like recently we've been hearing about repo, and there'll be, there's 34 billion in repo last night, and that's on top of the 17 billion from the night before. But that's not on top of the 17 billion. That 17 billion was repaid. Okay. And then they did 34. So it starts from zero every day. That's why it's called overnight repo. But something similar here is going on when you talk about debt financing, printing money to pay the debt. You're burning that money. You're printing it and then burning it, printing it and burning it.
Because they have incomes. Incomes only grow with GDP, and assets go up by the rate of debasement, which is at least 8% a year, plus maybe an inflation rate. So that's the whole game that is being played at every government level right now. We've got $10 trillion of debt to roll in the US alone in the next 12 months. And here's another way of looking at it. is here's the interest payments. The interest payments are what are getting monetized. And so total liquidity just follows the interest payments. So that chart tells you we've got around 7 or 8 trillion.
And remember, the interest rate, that this interest payments, that's somebody's income. So yeah, it's the government has to pay it, but it's going to somebody, right? So as interest rates go down, that means that interest income goes down.
Dollars that we need to print just to cover the interest payments over the next 12 months into the end of 2026, when things calm down a little bit for a while. What we realize within this is the cyclicality of all of this.
Okay, before you get into this, Telegram, you're seeing this double sharing up here. I don't know what's going on with my streaming stuff, but I'm seeing a double bar up here.
It suddenly became perfectly 4-year cyclical, starting in 2008. And it was all to do with the debt maturity. So 2008, we had a debt jubilee. They forgave all the interest payments and all the debts in all the major economies in the world. And when they did that, they restructured all of their debts. And they restructured them in the 3 to 5 year sector. So as they did that, they created this debt refinancing cycle where every few years they have to refinance all the debt, which requires liquidity. And liquidity drives the economic system. We had this perfect 4-year cycle.
So when does he say they started this? Because we've had a business cycle forever.
And this is where everybody's scratching their heads right now is, what the hell's going on? Has the cycle finished? That's the big question everyone debates all day. And for me, you can see what's happened here. There used to be this perfect 4-year cycle, and suddenly it's changed. Well, what happened here is we've added an extra year. In 2022, at the beginning of 22, rates were still at 0, and they extended the debt maturity by a year to 5 years. So we've got an extra year in the equation.
Okay, again, one thing I don't like about this is if he's talking about 2022, how come it bottomed in 2023 right on time? It should have bottomed out here in 2024, not 2023, after 2022. So it doesn't quite match up.
So all of the debts that need to get rolled in 2026 and not 2025. So that's why we've had less liquidity than we've expected at this point. You know, the banana zone point in the cycle has had less liquidity. So when we change it to the new 5.4 year where the debt maturity is, this is what we're going to get. So again, it gives you an idea that we're probably likely to peak out towards the end of 2026 in terms of liquidity, as opposed to this year. You can see the changes coming. They're changing things like the SLR, the supplement.
Just for the record, I like this hypothesis a lot, but I think there's some problems with it.
Supplementary leverage ratio that allows them to sell more treasuries to banks. We're seeing the Fed cutting rates. We're seeing changes in the money market. We're seeing the government ramping up fiscal stimulus. All of this is telling you that the big cycle still remains ahead. So you get this mega trend, which is the secular adoption trend driven by Metcalfe's law in Bitcoin, and it goes up and down. But when you detrend that, it's actually the business cycle. Everything on a year-on-year basis is the business cycle. People don't really understand this stuff. Once you understand this, it makes it much easier to understand how markets move when they move, what they do. It's even easier when you know that we've got a predictable business cycle based on debt maturity. So here's the Russell 2000. Which is essentially small caps, basically the same. If we go forwards to crude oil, same. If we go through to industrial metals, the same. Everything, literally everything in the entire investing world is driven by this cycle. And the business cycle has been subdued. Listen to Scott Bessent. He's telling you all day, as is Trump, is we're going to have a banner year next year. Why? Because they're going to jam the market with liquidity, and they're going to jam fiscal stimulus through as well. Yeah, if you think about it, the US is a service-based economy. They're going to get rid of tax on tips. That's a huge boost to people. There's like $1.5 trillion that will flow into the banking system just from that stuff alone, from the big, beautiful bill. Then we've got the changes to the SLR that allows maybe $3 or $4 trillion of credit creation from the banking system. We've got enormous amounts of this stuff lining up. Why? Because they want to win the election. The good thing is, for once, we've actually got a macro hedge fund manager running the treasury. So I know how he thinks. He was a long-term global macro investor subscriber. I've known him for 20 years. And he understands the game, which is jam the business cycle going into the elections. So are we at a top, which is the thing that people bleat on all day on Twitter, with the top of the cycle? We can't be, because we're not topping in the ISM. In fact, we've not even gone above 50 yet, so we've not had economic expansion. Main Street has been struggling. They need rates to come lower. They need fiscal stimulus, and that's all to come. So when we start looking at forecasting models of the business cycle, here's the interest rate model. That suggests to us that the economy strengthens fast and quite dramatically in the next 6 to 9 months. So that's good for altcoin season. That's good for crypto.
Altcoin season, crypto. Shut up, man. Nobody cares about altcoin season anymore.
That's good for all risk assets. The correlation of the two things of total liquidity.
Notice he says altcoin season and but he shows a chart of Bitcoin. Come on, man. See, that's why I preface this with saying that he's a bit of a scammer.
In Bitcoin are extremely high. In fact, the correlation is 90%. Statistically, that is absurdly highly correlated. When you look at the NASDAQ, it is even more absurdly highly correlated. It's 97.5% correlated with money printing. So money printing is the story that drives this. Liquidity, where are we now? Well, year-on-year liquidity is not very impressive. This kind of slow grind higher has been what we've lived through in crypto from the bottom. It's kind of stop-start. It's because liquidity is not flowing through the system. We've had broken plumbing, and we've had no need to do it yet because we don't have to roll the debt until 2026. When we look at financial conditions, our lead indicator, and put them against total liquidity, well, we've now got a lead, a 3-month lead, and it tells us.
Hey guys, if you're watching on YouTube, like and comment. I'll address your comments when I see them. Let me see if I have any from Telegram. Okay. Again, I like this model. All things are kind of pointing to reacceleration. But one thing that I'll point out, we've had spikes in SOFR. We have the demographic issue. We have the China issue. We have the Japan issue. All of these economies are, well, Japan might be accelerating a little bit here because they are doing, a ton of investment into their economy, but they have the bad demographics, so they'll be shrinking naturally from that. China demographics are horrible. They're shrinking. I think they're trying to stave off a Great Depression like reset over there in China. And so there's a lot of and we have deglobalization with the tariff wars and all of this stuff. And so going forward, yes, there are a lot of things that are lining up for an expansion. There are also a lot of things lining up for continued contraction. And so what is the happy medium for that? And I've talked about this in the chart. So let's make sure this is sharing properly. So if we go to ISM PMI, Purchasing Managers Index, take off these. So like I said, we have different forces that are towards expansion and different forces that are towards contraction. All right. So the base case is continued sideways. That is my base case. There is slight, you could say maybe a slight bias upward here on the ISM. But overall, I would say that this is the base case. And if you don't have this as a base case, you need to say why these other structural negatives are not in your base case. All right. This also matches my base case for the global economy overall, which I just got done on with that big monologue 2 minutes ago about how we're looking at another 20 to 40 to 50 years of stagnant growth. And that would go along with this ISM PMI just going sideways in either mild contraction or mild expansion. So let me draw a better path. So yeah, we could see something like this, okay, for the foreseeable future, out many years. So instead of being up like this, dipping down just a little bit, coming up here, dipping down just a little bit. Okay. So instead of this red path, we get the black path, which is minor expansion and minor contraction forever. For a long time. I'm talking lifetimes here, probably like the rest of my lifetime. We could see something like this. So if we go back the first part of my lifetime in this era, let's go about right here, you know, that is characteristically different than what we're going to see going forward in the future. Okay, most of the time spent quite a bit above 60 on the PMI. Can you imagine 60? Bouncing, bouncing, bounce, bounce. And we traded off for this going forward. So anyway, that's kind of what I'm thinking. That's going to be it for today, guys. Thank you for joining me. Make sure you like and comment if you're watching on YouTube. Also jump over to the Telegram. I'm going live on Telegram as well. We hash it out. There's about, I would say, 50 of us that are real active, but we do have close to 800 members there on Telegram. So come over and join us. Make sure you subscribe to Ansel Lindner on Twitter and Rogue Macro on Twitter as well. So, all right, guys, that's it for today. Thanks for hanging out, and I'll see you later. Bye.